Okay, now let's try to understand the allowance method wherein which is accepted by the GAAP as well. So what does happen in the allowance method? Let's try to understand through an example. So the company's name is Best Buy, an electronic retailer sells 1 million worth of product to customers on credit. These all have been sold on credit, $1 million, and in the month of December. At month end, accounts receivable total $600,000. Based on historical data, industry averages, and current forecast of the consumer credit risk, they have forecasted that what are the risk of collection based upon history, that 2% of the receivables from the general customers are expected to default. So generally 2% will default. So out of this 1 million credit sold, only 600,000 is remaining as on balance sheet date, which we still need to receive. And on this, because this is the pending final balance from the debtors, 2% is treated as a general default. And then they are saying 6% of the receivables from high risk financing customers are expected to default due to rising unemployment and lower disposable income. So effectively what they are saying that 6% of receivables from the high risk financing customers are expected to default. Okay, now the breakdown is like this, that general customers receivable will be how much. So basically we are saying that 600,000 we still need to receive, and the printing is not entirely complete, I believe here. So we need to add one more line here, that this $600,000, out of that $500,000 I can say belongs to general category. So let me write at general category here, and remaining remaining $100,000 belongs to high risk financing customers category. So these are high risk financing categories customer. So how do we recognize the provision or allowance for these bad debts? So we know that general category customers are of $500,000. It was not printed, so I have written it here. And there are chances that 2% will be bad debt, so 2% is taken. So this gives us the expected loss of $10,000. Similarly, for this $100,000 customers, the expected loss is 6%. Why? Because this is expected based upon history, which gives us 6,000 of expected loss. We call it as ECL, expected contingency loss. So we can simply say that our total ECL, expected contingency loss, is $16,000, which is given here, right? So what general accounting entry will be passing on December end? So we can simply say that now we are making an allowance. We are not directly charging the I can say debtors. Why? Because this method don't hit the AR balance, because this is only expected. This is not final. This is based upon historical trends. So what we will be doing, we will be simply passing a general entry of bad debt expenses. So these are debited because these are our expenses, and we will be creating an allowance account. So this allowance account is credited for 16,000, and this allowance account is basically a provision account, I can say, or a liability account, I can say. So bad debt is debited because this is expense, and the remaining account, which is allowance account, is credited. Okay, now what will happen? Let's suppose in the month of February a customer with $2,000 balance goes bankrupt. So now the customer is bankrupt, and it becomes clear that the receivables cannot be collected. Now no money will be collected. Now you won't be passing the entry at that time like bad debt to accounts receivable. We won't be passing this entry. This won't be done. Why? Because we have already created the provision instead of this bad debt. So this is just like a box wherein we have kept $16,000, and we know that whenever the bad debt will be happening, we will be picking the money out of this box for those bad debts. So this 16,000 bucket is sitting here. So what we will be doing, this was credited, and we need to reduce this amount because we are pulling the money of $2,000 from this bucket. So basically this allowance for doubtful debt is debited, and we know that now we won't be receiving our accounts receivable worth $2,000, so this will be credited. So effectively we can simply say that which accounting entry will be passed. We can simply say that the accounting entries of allowance for doubtful debts to accounts receivable. This entry will be passed. So effectively what's happening? No additional bad debt is recognized at write-off since loss were already anticipated in ECL. So these are very important entries, and the questions are being asked across these entries at multiple instances. So we need to be aware about these. Now let's go and see the same thing in the what I say textbook concept. So what does the textbook says? This says that the current ECL model we need to recognize once collection is probable, we record the receivables, and we also estimate the expected losses over its time. And when we do the estimation, no fixed method is prescribed. We don't know how to prescribe the estimation. We may take it based upon industry standards, or we can take it based upon past experience, or we can take it based upon other elements as well. So there is no fixed method prescribed. Now what we can consider: the age of the customer, the industry standard, region, credit ratings. Lower the credit rating, we know lower will be the chances to recover the money, and future economic conditions, like if there are going to happen recession in the market, then the people won't be paying us very high. There are chances that there will be bad debt. So the situations of the market, based upon that, these percentage of what I called these percentage of bad debts, just like 2% and 6% are being determined. So there is no specific method to determine that. That will be given to you on the question itself. So what we do in allowance treatment: the percentage of ending accounts receivable is estimated accounts uncollectible. So this is the closing accounts receivable is treated as uncollectible. It's not that whatever credit sale you have done, that is uncollectible, because out of that there are chances that you might have received some of the money. So the entry is always the bad debt account debit, because this is our expense, and allowance for uncollectible, this is our provision. So we are debiting bad debt and crediting this provision. Now what do we do? Write off. Then specific uncollectible accounts are debited to the allowance accounts. When we need to do the write off, so simply what we do, we debit this allowance account and credit what? This AR account. So this becomes our entry. Now there are two different methods which are generally accepted for this, which is percentage of accounts receivable, which we saw, just like 2%, 10%, etc., and aging of accounts receivable. When I say aging, it's like if you have sold today, then there are chances that they will be paying very quickly. If you have sold 1 year before and still the money is pending, so there are very less chances that they will be paying. And think of a situation where you have sold 3 years before and still the money is pending. So based upon aging, that how old your debtors are, you can determine any method. So there is no method determined, but overall the accounting entries needs to be this one plus the other one which we had seen above.